Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today I dissect the FOMC statement and discuss the risk-reward for the housing market and banking industry. My first blip repeats the Fed's warnings as they cut the federal funds rate by 75 basis points to 2.25%. The Fed says recent information indicates that the outlook for economic activity has weakened further. This is another downgrade to the U.S. economy. The Fed's target for 2008 GDP growth is 1.3% to 2%. The Fed is getting closer and closer to using the R word. The Fed says growth in consumer spending has slowed and labor markets have softened. Initial jobless claims are trending above 350,000 and consumer confidence is below 75. Both are recession warnings. Despite dramatic moves during last weekend's takeover of Bear Stearns by J.P. Morgan, the Fed indicates financial markets remain under considerable stress and the tightening of the credit conditions and the deepening of the housing contraction are likely to weigh on economic growth over the next few quarters. It seems to me that Bernanke has his helicopter revved to the max, but I see some signs this week that the credit crunch has eased somewhat. Yet, the Fed shows little confidence. My second blip reiterates that I agree with the Fed that the housing contraction is not over. Earlier this week, we saw the National Association of Home Builders Housing Market Index continues to scrape the bottom of the barrel with a March reading of 20 versus a neutral reading of 50. We also saw continued declines in housing starts and building permits in February. The Residential Housing Sector Index, HGX, shows a trading range with the floor within the realm of May 2003 lows. Be aware, the home builders may provide trading opportunities, but with sell ratings. My third blip reiterates my opinion that rate cuts will not make bad loans solvent. I agree with the FOMC that credit conditions continue to tighten, but I believe the Fed moves this week have greased the wheels of the primary dealers, which should help ease the credit market logjam. This helps Wall Street, but some community and regional banks on Main Street are not too big to fail. Remember that Bernanke recently told us there would be some bank failures. The Regional Banking Index, BKX, has bounced from levels not seen since early 2003 before subprime loans were originated. The daily charts show a trading range after a new 52-week low on Monday. The regulators know that the subprime problems are not over, and investors should be aware that community and regional banks are set to report miserable first quarter earnings starting in mid-April. This week I have cringed with comments in the media that these banks have strong balance sheets. Wall Street has ignored the FDIC quarterly banking profile, which in my opinion is the most important economic data. Let me pound the table one more time, as I have done so many times over the past 2 years. Community and regional banks are overexposed to C&D loans, commercial real estate loans, and home equity loans. My fourth blip reiterates that stocks are in a range before confirming the next leg to the bear market. A close below the January closing low for the Dow Transportation Average at 4,140.29 confirms the next leg of the bear market for U.S. stocks. Transports rallied 237 points on Tuesday, which delays this possibility, but also observe that this average remains below its 200-day simple moving average at 48.01. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.